Let's cut across to Barclays India conference where Tanveer Gill is in conversation with Mark Mobius, and we'll talk about the Indian economy going forward.
Odd.
Right.
So kudos to you on that. But
Thank
do you think that the story can go on? That 13,000 definitely would be a reality for the Nifty, building on gains that we made this year into 2018 as well?
Definitely. I mean, there's no question that we're going to continue this trajectory. And that's true not only of India, but of emerging markets generally. Because if you look at the emerging markets index, the global index, we are still below the 2017 high. So 2017, 27, we're in a situation where we've got to break through the 27 number, and I believe we will probably go beyond that by about 20%. That's
Wow.
my calculation.
Wow. But tell me, I again recall that conversation primarily because you said a couple of factors would push India higher from here, which would get captured in the Indian markets move. And that is full implementation of GST and pick up in earnings because of that. Where are we in terms of what you've seen as far as GST implementation goes? And what do you make of the earnings cycle?
There's no question that GST implementation has been very complex, as we just heard from the principal advisor to the economy. It's great that they put it in place, and now they have to fix it. They have to get it implemented. And there's no question that there's a lot of complications, particularly in the service sector. I believe the different categories of tax are much too complex.
That's right.
And hopefully they'll simplify that. But probably the most interesting and important factor now is the behavior of the individual states. Because the move by Modi to put more and more power in the hands of the local states at the local level is going to have a very beneficial effect on the economy going forward. And there'll be tremendous differences from one state to the other. You're going to see some states surging ahead, some not doing so well. But overall, it will be a very, very beneficial impact to have that kind of state-level attention.
Right, but when do you see that, the transition to GST and its full implementation resulting in earnings? Because I remember you mentioned that by FY19, you see earnings picking up to 18 to 20%. Right now, there's a big lag there. We are still struggling with breaking past 10%. Every year we start out with 15, 16% on earnings projections, and then we scale it back, and the reality turns out to be, an 8 to 9% kind of range.
That's the average. You must remember there are, of course, a lot of laggards, but the good companies are growing at least 20%, and maybe even more. And I believe that's what you got to look at. You've got to look at those companies that are really leading the economy and growing at the pace that they should be growing, which should, given the fact that the economy is growing at this pace, the company should be doing at least double and even triple that rate.
No, but the average baseline, do you still keep your view that FY19 will capture the full effect of GST, and that will reflect in earnings growing at 18 to 20%? Do you keep that view? Do you still hold on to that range?
Yes, I do. But again, as I mentioned, there'll be a lot of laggards so that the average may be pulled down. Let's put it this way. If you did the average based on market capitalization, you would probably get closer to 15, 16, 17, 18% level.
Okay. Let's talk about India's growth potential. Right? We have seen the numbers hit a bottom at 5.7. The last print had come in at 6.3. What kind of sustainable growth trend do you expect from India?
I think that you're going to see an accelerating trend. And we're already beginning to see that, as a result of the reforms that have taken place. So 10% growth is in the cards. There's no question that this will be achieved again going forward. And I think a lot of the impact of the urbanization of the economy will push this number forward. In other words, you're going to see this acceleration in the economy. And most importantly, I believe, is if the government is able to implement a privatization program which is meaningful and aggressive. In other words, particularly in the, if you look at the infrastructure sector, more and more privatization, railways, power, roads, bridges, etc., etc. This has to be very aggressively done because that will push forward the economic growth of the country. And more importantly, it will draw in capital. It'll mobilize capital at a faster pace than we're seeing now.
Right. Do you think India among emerging markets after this run-up as well continues to be in value zone? Because I remember recently you put out a note saying that for the emerging market world, you see the 12-month forward PE at roughly about 12.5, 13 times compared to 17 times for developed markets. And you see the 12-month EPS growth standing at about 13.5 times versus 13.5% versus 10.5% for developed markets. Does that put India still in a value zone? Because many believe the markets are stretched at 2021 times. So I know that the long-term bull market might be intact, but could there be an intermediate correction?
You must remember that it's true that the valuations of the Indian stocks are higher than the emerging market average. But the reason for that is that people are factoring in the growth rate that they see going forward. So when they're valuing an Indian company, they're saying, okay, this company's going to be growing at 20, 30% going forward, and therefore we're going to upgrade our valuation. So that's what you're seeing.
Yeah, but at some point, Dr. Mobius, one would believe that there would be a point where money must be taken off the table. I mean, look at Maruti. It's a compounding story, and it continues to go higher and higher. And it just makes me wonder that, even at 9,000 rupees per share, is Maruti in value zone? Because you buy it at any point, and you're able to generate returns for your investors.
But don't forget, we're looking at Bharathi 5 years from now, not now.
Okay.
And you must remember, when we look at these markets, we should not be pessimistic for the simple reason that we haven't reached the euphoric stage. Yeah. Markets die on euphoria, but we haven't reached that yet. It's similar to the Bitcoin situation.
Yeah, and we'll talk about that.
People are not euphoric yet.
Yeah.
Wait till they become euphoric, then we can see the end of the bull market.
Yeah, in fact, you actually made that comment recently that markets peak out on euphoria, and this is a skeptical bull market, so I think there's more headroom here. Let's talk about the big Moodys upgrade that came in for India. What does it really mean for the country?
It means a lot, because it means that the minds in New York and London are saying, gee, India looks a heck of a lot better than we thought, and we're going to upgrade, and it's going to become a less risky story for bond investors. And also, of course, this laps over into equity investors.
Yeah.
So it's very good. It's very positive.
The immediate plus that most were expecting, this development to bring by is more accessibility to cheaper funds by Indian corporates, especially infrastructure companies. Would it convince global investors that the risk associated with these businesses would perhaps, reduce if they were to buy into some of these companies in India?
There's no question. I mean, these investors are basing their investment decisions on the Moodys, S&P, and all the other rating agencies' opinions. So there's no question that more money will come in if the conditions are correct. In other words, that's the big question mark.
Yeah.
If the government makes it easy for people to come in and make those investments with the proper guarantees in terms of contracts.
Right. So, what are foreign investors really looking at? Because I know that the cry for money when it comes to investment infrastructure projects is just getting louder and louder, with the numbers getting bigger and bigger. What can the government say or do to convince foreign investors that, look, your capital will be protected?
Number one, the contracts that are negotiated with these companies in any infrastructure project has to be guaranteed, hopefully by a multilateral agency, because then it gives the foreign investor some sense that they're not going to be in a situation where the contract is changed. So that's number one. Number two, the ground has to be prepared. For example, if you're going to build a road, we have to get the land in place. The government has to do that job. The private company can't do it. And if it's delayed, if this process is delayed, then it becomes a very expensive proposition. Because this is the advantage that the Chinese have. They can say, look, we need this space, get out, and that's, in India it doesn't work that way. But this is something the government has to work on. It has to make it easy for pathways to be made so that people can make these investments safely. Other than that, the investor is willing to take the risk for the actual project, the profitability of the project. That's something that they're willing to risk. But they don't want to take the political risk and the clearance risk, the right-of-way risk.
Okay, let's talk about the banking sector in India. What did you make of the PSU Bank recapitalization plan?
It's great. More capital.
Is it enough at $32 billion? Given that, I was reading now the numbers keep varying, but, you're talking about a bad loan pile of anywhere between $150 to $200 billion. I think that's what the number that Mr. Uday Kotak recently highlighted or stated as, being the pile of bad loans in the banking system. Is that enough? Is 32 billion enough?
It's small as a percent of GDP, no question about that. And it's significant enough to get the banks moving in the right direction. I think it's enough. It's just about enough. But you must remember, the government program is based on, of course, money coming from the budget, but also money being raised by the banks themselves. Yeah. So with the upgrade, they will be able to attract more capital from domestic investors and also overseas. So I think the government input will be a very small percent of what is raised in the market.
Okay, I have to tell our audience out here that, same time last year, actually, when we had that conversation in October of 2016, you had mentioned to me that you see value in PSU banks. And you may have gotten it right because we saw a big spurt in perhaps the biggest rally, intraday rally that we saw in these stocks in history. Do you think that now is the time where PSU banks can actually take off?
Our biggest allocation in India is the banks. So
the banking sector, but
the banking sector.
PSU banks?
Yes.
Okay.
Because they're the biggest and the most liquid. So
yeah. So see, that's the other trick point, right? The allocation really comes into the SBIs and the Bank of Barodas from the banking space. But this is really about setting the banking sector right. This is about fixing the banking sector issue.
That's right.
So where do you stand on that story?
So we're now more bullish on the public sector banks. When I talked to you, a year or 2 years ago, we were more interested in the private sector banks like Federal Bank and these. Now we're more positive as a result of this reform on the public sector banks.
So you would be going overweight on PSU banks and across the board?
Yes.
Where does it leave the story for PSU bank consolidation? Because, skeptics believe that all of the banks will not be able to wriggle out of their issues very easily. And so the path ahead would be, the strongest banks survive and perhaps they take the weaker banks into their fold.
I think that's definitely going to happen. There are probably too many banks, too many small banks, and you're going to see consolidation coming in place. Particularly with the new rules, with the new examination of these banks to adhere to these new rules, you're going to probably see some of this consolidation taking place, which will be good for the system at the end of the day.
Okay, so recently, and I'll just then move on to your global market outlook, but recently somebody asked you if you had $100,000, where would you invest that money across asset classes, all over the world? I would say if I were to give you, not me, well, if you were to have $100,000 to invest in India, where would you invest and why?
The place where I would invest is those states where things look bad. There are a number of states in India which now have fallen behind. They don't have the growth rate that like some of the other faster growing states. So I would probably look at those states to begin with, because I think the government policies are going to begin to infiltrate into those slower growing states. And there'll be opportunities, and we'll be able to find cheap stocks in those places. Now, some of this would have to be private equity, but that's the place where I would begin to look.
And what about the expensive consumer names?
In terms of sectors, I would say consumer-oriented sectors, because
even at these valuations?
Even at these valuations, because don't forget, at these valuations, the large cap stocks can be expensive, but some of the small cap stocks are very interesting. So that's what we would look.
Okay. How does India stack up against other emerging markets? From a perspective of looking attractive for foreign investors. Like you said, it's not really in the cheap zone, but it's not very expensive either. When you look at the emerging market world, how do you position India currently?
Let's remember, if you look at the emerging markets world, it's China and India. Those are the big boys in the block. So you've got to be exposed to both of those countries. Then along the way you'll have something in Brazil, of course Thailand, or some of the Southeast Asian countries look interesting. In the frontier markets, Vietnam is very interesting, and of course a number of African countries. But if you look at the totality of where we are, India and China are really the ones where we have to be exposed. Now, China has become quite big in terms of its weighting.
Yeah.
Even if you're not looking at an index, in terms of where you can buy, China is very big, 26% plus. So what we see is India coming up much faster and equaling China in the weighting. But that will require much more equity coming into the Indian market, more privatizations. Because at this stage, there's not enough to go around. One of the reasons why you have this high valuation is because the choices are somewhat limited. So that's what we see going forward.
But 2017 has been such a great year for world equities, Dr. Mobius. How do you foresee that trade playing out for 2018? Do you think that, and in 2017 everybody's done well, right? You have emerging markets which have done well, you have the developed world which has performed. How will the trade pan out, or how will the equation work out into 2018? Where will the bias be?
I think the bias will still be with the emerging markets. I think emerging markets will still be surging ahead and outperforming. In the short term, I mean, you might see a few months where emerging markets are underperforming the developed countries, but in terms of the 1 year, 2 year, 3 year framework, you're going to see emerging markets outperforming. And I believe this will continue through 2018 and 2019, 2020. Because the growth rates are there. You must remember that we have very high growth rates. The average growth rate in emerging markets is about 4%. Now that includes a lot of deadbeats, a lot of countries that are not growing at all.
That's true.
And it's a 4% average compared to, let's say, 2% for the developed countries. The good news is that the US is doing pretty well, and now Europe is coming in.
Yeah.
So this helps the overall picture and actually boosts emerging markets as well.
You're painting a picture-perfect scenario. As if there are going to be no risks. We're getting into 2018. I still remember that when we were getting into 2017, the world was a little bit wary about, okay, how will the rate tightening cycle in the US pan out? What would that mean for global liquidity conditions? What would the balance sheet unwinding by the Fed, again, mean for world markets? What will happen to the bond markets, which are seeming overextended right now? Is there a bubble brewing there? But sitting out here, and as we step into 2018, one is like looking for risk factors, but there aren't any. Yes, North Korea fires a missile every odd week, and that's an area of concern. But that also, as a risk factor, is now kind of dwindled because everybody believes there's a lot of talk there than than action per se. This is more rhetoric than something that can translate into reality. So, what are the risks?
There is a risk with North Korea because I believe that the U.S. administration will want to take some action, some military action, like shooting down one of the missiles that they put up. This could create a real massive correction in the markets globally, but it could happen.
When is that likely to happen, Dr. Mobius? Because you timed the target on the Nifty. You may perhaps time this too.
You must remember, you have an administration in the U.S. that wants to act, wants to do something. You see what's happening.